Credit stacking is not going to get the capital that you think it's going to get you for your business, and I'm going to explain why in this video. Now, if you have no idea what credit stacking is, this is essentially the process of you applying for multiple credit cards in a specific order, in a specific time frame, and then essentially you're stacking the credit applications in hopes to get access to multiple credit lines at once for your LLC, your corporation, S corp, C corp, whatever it is that you're looking to fund. Now, in theory, this sounds like an easy process, and in theory, this sounds like something that you can easily set up and do off of a win. But I can tell you it actually ends up flopping more often than it does succeeding. And in this video, I actually want to break down some fundamentals that you want to have in place before you actually try to go out and apply for business credit or you try to get capital for your business. First thing that you want to know is that there is a timing that's involved whenever you're looking to get access to business capital. Now, it's not just the timing that most people think it is, which is let me just open up a bunch of tabs and a bunch of windows and then just apply. And then hopefully I'll get approved for a couple of 0% business credit cards and then I'm good to go. No, no, no. I want to take it deeper. And if you've been following this channel for some time, then you know that we like to get granular here, and that's this. The timing of which you apply for business credit is going to have a direct impact on the amount of capital that you get, especially at scale. Anyone can get access to 50, 100K like right now, but it's a matter of when you're thinking long term, 60, 90, 180 days out, can I rinse and repeat the process, which is what we work on with our clients day in, day out. We help them install simple funding setups directly into their businesses. And so when you're considering the timing of when you're going to apply for business capital, you have to consider a few things. The first thing that you have to consider is the financial institution, whether it's a bank or a credit union, we'll typically use that interchangeably for the purpose of this video, just to keep things simple. Is it the right time for me to apply at this financial institution? And so there's a couple different things you have to consider. Do you have liquidity, meaning cash, in the accounts that you're applying at? Because not every bank and every financial institution are they going to want to do business with a business that doesn't have a partnership with them. And so one of the first things that you want to consider is, before I even submit this application, is this a liquidity based bank? Meaning you got to have some funds in there before they even consider your application. I can't tell you how many times I see it. Someone submits a credit line application at a bank, at a financial institution, but they don't have any liquidity in it. So it doesn't matter if their credit score is above a 750. It doesn't matter if their entity is over 10 years old. It doesn't matter if they're driving $500,000 through their business. There's no internal log with that business. The second thing that you want to consider when it comes to the timing of your business and your application is going to be the timing of if you've already gotten access to capital at a previous bank. Some banks, especially the bigger ones, like if you're talking about Chase, Wells Fargo, Bank of America, with those type of financial institutions, they don't want to see too many recent approvals. And I know it sounds counterintuitive, but they don't want to see too many recent approvals, any recent credit lines opened, because they'd actually prefer for their business, or like the way that their business model works, for their business and for their banking venture to do business with you first. And so there's something known as a UCC placement. And so if you're talking about UCC filings now, which are uniform commercial codes, this is fancy way of saying if you have debts with an existing financial institution. So an easy example for this is going to be a mortgage. That's typically a lien placed against you, the homeowner. And until you actually pay that mortgage off, whether it's a 15-year term or a 30-year term, then they're like, that's going to be reporting on your credit that you have an outstanding lien. It's the same thing in the business credit front. So they have what's known as a UCC filing. And so they'll typically put this on business lines of credit. And so there's a first place UCC filing and then a second place UCC filing. First place UCC filing means that if the business, God forbid, defaults, that financial institution has first dibs on the liquidating process of the business, meaning they get their money first if like you have to pay them out, right? Or the business in this case has to pay them out. Second place is going to be any finances or any money that's like left kind of like over, then they get like second dibs on it. Irv, why are you kind of like taking us on this rabbit hole? The reason why I'm taking you on this rabbit hole is because if you have a business and the way that you've set it up is you have the wrong order of financial institutions that you've been trying to get funding for. So maybe you put a smaller bank or a credit union above a bigger bank. Well, guess what? The bigger bank's gonna say, no, wait a minute, like you're out of order here, so the timing's off. We'd actually prefer to be the first approval for you versus it being the other way around. And so as you're thinking through, and this is one of the things that we help our clients with all the time. If you need any help with any of this, by the way, like book a call down below. We'll deep dive into your business, take a look at where it's at and what funding setup makes best sense for your industry, your line of work, where you're located at geographically, how much revenue your business is driving in. Like we'll take a look at the whole shebang, right? And we'll let you know this is like what we do day in, day out. But as you're thinking through your funding structure, this is something that you want to have in place. Is the financial institution that I'm going to, should this be like at the top, or should I put them at the bottom as I'm going through my funding period? The second thing that I want to address, though, when it comes to why credit stacking fails, especially at scale for so many people, is because you have what's known as a lending pool. And this is probably one of the bigger mistakes that I see. And each lending pool, so I'll give you an example. You have Bank A and then you have Bank B. Bank A has their own underwriting criteria. Typically, you'll see this with bigger banks like Chase, Wells Fargo, Bank of America. And those bigger banks, they have their own lending criteria, meaning they have their own underwriting department. And so that's one pool. The second pool, though, is composed of a ton of smaller banks that outsource their underwriting to third parties. So a good example of this would be, and this is like maybe your first time hearing it, but it would be an Elon Financial. It would be a TCM type of network. It would even be an FNBO. This is your first time hearing this, then let me put you on some serious game right now. This means that if you go into this, let's say Bank B, and then there's also Bank C and Bank D there that you think you're gonna apply for a business credit card for or a business line of credit, you're still being underwritten by the same third party network. And so you actually haven't left that lending pool. It's kind of like taking a fishing rod and just fishing in the same pond, and then you're essentially trying to catch the same fish, versus instead of switching out the fishing rod, which in this case would be your business, you just move over to another pond so that you have another a vast variety of fish that you could essentially catch, which in this case would be business funding products. And so I see this mistake all the time where somebody is trying to set up their business funding and I'm like underwriting it and I'm taking a look at it with them and we're masterminding and I'm saying, okay, let's audit this. The 4 or 5 different products or financial institutions that you're looking at, they're all inside of the same network. And so as soon as you get approved for like the first 2 products, so in this case, let's say one business credit card, one business line of credit as the example, or the example in this video, you've exhausted it in that pool. And so every future application that you try to submit a funding round for at that point, especially with the timing, it's going to get denied because you've already tapped that network out. And so at that point, it's about strategizing and picking a new network that you can tap into that you haven't already exhausted the funding potential for. This is, again, what we do day in, day out with our clients. If you need any help with any of this and you want to take a look at your business, see how we can help you structure a simple funding setup directly into your business, feel free to book a call down below. We'll deep dive directly into your business and we'll let you know exactly what we can do and how we can implement this process into your business.